The tape doesn't tell stories, markets do. And right now, the market's telling a story that contradicts almost every headline about oil going into 2026. Oil prices are stuck at $60 a barrel. Everyone from Goldman Sachs to the EIA is forecasting a collapse. But underneath that narrative, something's changed, and it explains why the biggest risk to your wallet aren't the ones making the front page news. In the next 4 minutes, you'll discover why consensus is betting on $55 oil, while the market's behavior says something completely different, how geopolitical risk that should be terrifying investors isn't moving prices at all, and what the real constraint on crude supply actually is. Spoiler, it's not what you've heard. I'm Mark Roach, petroleum engineer, deal maker, 30 years in this business. This is FutureWise Energy, independent analysis. Here's the baseline data. WTI crude closed January 20th at just under $60 a barrel. That's down from 73 last year. Every major analyst is pointing at that number and saying crude's headed lower. The IEA projects a $4.2 million crude's heading lower. The IEA projects a 4.2 million barrel per day surplus in 2026. Well, that means that the world is producing far more oil than it's consuming. When supply outpaces demand like that, prices fall. It's basic economics. The consensus is calling for $55 oil or maybe lower. And that's a reasonable hypothesis. But here's what's interesting. If that hypothesis is right, you'd expect the markets to be pricing in barrels for delivery in 6 months at $45 or $50 a barrel. Future prices signal what traders actually believe, and they're not. Front month WTI is $60. 6-month contracts are in the mid-50s. That's a slight discount, but not the collapse consensus is expecting. The translation, traders are skeptical of the consensus forecast. They're hedging against the narrative not playing out. So why would traders doubt an outlook that appears mathematically sound? Because they've seen this before, 2015 and 16, 2018 and 19. Every time analysts declared crude would stay cheap forever, supply discipline ultimately tightened the market. Companies stopped drilling at low oil prices, production declines, demand rises, the balance sheet resets. Suddenly you're back to $60 to $80 oil. What's changed in the past 30 days? Several things. First, geopolitical risk has shifted. Venezuela's political structure is now under U.S. control. That should have been massively bullish for oil markets, but massive supply disruption, geopolitical premium to crude. Classic risk event. Oil should have spiked. Instead, it stayed flat. Why? Because the global glut of 4 million barrels per day surplus makes individual disruptions irrelevant. You lose 2 million barrels per day from Venezuela or 1 million barrels per day from Venezuela. They're already sloshing around in floating storage and these refinery tanks, and the disruption doesn't really move the needle. Well, that's the key insight markets are pricing in. Geopolitical risks stop mattering when surplus capacity exceeded annual demand shocks. Now, second, refining margins started moving. That's where you should focus if you're thinking about what you pay at the pump. Refining margins are the spread between what refiners pay for crude and what they sell gasoline and diesel for. When margins compress, gasoline stays cheap. When margins spike, you pay more at the pump regardless of crude prices. Right now, margins are actually rising because heavy crude supplies are becoming more reliable. That supports fuel prices, but it also suggests refiners are getting feedstock that they need. Third, the capital discipline that's defined every energy investing mechanism for the past 2 years is not going away. It's not breaking. Oil majors could be announcing massive new projects, but they're not. They're returning cash to shareholders. ConocoPhillips and Exxon are announcing buybacks and dividends, not drilling programs. That tells you something. At $60 crude, executives don't see an investment opportunity with acceptable returns. They're comfortable with production staying flat. That means drilling in 2026 this year will be restrained. That means supply discipline will persist. So here's what that means for your wallet. Gasoline prices at the pump depend on three things. Crude prices, obviously, but also on refining capacity and fuel demand. Right now, refining capacity is tight globally. That's supporting margins. Fuel demand in the U.S. is essentially flat. We're producing more oil than we consume, so we export the difference. Surplus crude stays affordable, but refined products stay supported. Translation: gasoline in your home state probably stays between $3 and $4 per gallon through the first quarter of 2026. Maybe lower if crude drops faster than expected, but maybe higher if refining margins spike due to maintenance outages or unexpected supply issues. Chaos in the Middle East. But don't expect dramatic swings based on oil headlines. The system does have a cushion. The bigger picture, the consensus view is mathematically sound about the surplus, but markets don't move on mathematical models and ideology or in perfectly liquid conditions where their free market is moving. Free markets move on where the binding constraint actually sits. And right now, the binding constraint isn't crude supply. It's refining capacity and the specialized equipment to process different crude types. Refining is the choke point. Crude is abundant. And that distinction explains everything. Why geopolitical risk isn't pricing in. Why refiner stocks are rising while oil stocks are struggling. Why capital discipline is staying intact, and why the market's looking past crude prices to downstream cash flow. For investors, that means energy capital doesn't go toward crude production this cycle. It goes toward refining assets, carbon capture, technology that reduces operating costs. That's where returns sit. Permian barrels at $60 are marginally economic. Refining barrels at strong margins are quite profitable. The warning signs could be clear if this consensus broke. You'd see crude prices spike despite surplus. You'd see futures curves steepening because traders are bidding hard for near-term barrels. You'd see OPEC cutting deeper because they sense demand accelerating. You'd see refining maintenance schedules shrinking because refiners are not desperate for capacity. None of that's happening. The market structure is actually quite comfortable. The risk? The supply discipline breaks. A major producer decides to abandon price discipline and starts pumping. Or unexpected demand surge in China exceeds expectations, or a production decline accelerates faster than models project. Any of those scenarios would crash the consensus and push oil toward $70 to $80 a barrel. But the baseline case right now is restrained supply, adequate demand, and margins held by refining constraints, not crude availability. The data supporting this baseline is strong. Rig counts remain depressed year over year. Capital budgets haven't shifted materially. Drilling activity in the Permian has actually declined despite Trump's rhetoric push for increased drilling. Economics matter more than policy rhetoric. At $60, drilling isn't justified, and that's discipline talking. Keep watching the rig count, not the headlines. Watch refining margins, not OPEC announcements. Watch supply discipline metrics, not political speeches. When you see the evidence that those fundamentals shift, then you reassess. Until then, the market's quiet because the market's comfortable. And comfortable markets don't move much, regardless of how many geopolitical shocks make the front page news. Your price at the pump stays reasonable because the refining system can process the crude we're producing. That system will break when refining becomes a genuine bottleneck, and we're not there yet. When we are, You'll see it in the margins first before it hits your wallet. Watch the signals, ignore the noise. I'm Mark Roach. This is FutureWise Energy.